S&P 500 just had its best single day since last May, where it was up nearly 3% after being down nearly 9% from its highs just a week ago. So it just went from this to this. But the question everyone is wondering right now is whether this is the bottom or just a dead cat bounce. In this video, I'm going to walk you through the 3 scenarios for how this war could play out and what the data says you should actually be doing right now. Let's not waste any time and let's jump right in. So we are now 4 weeks into the US-Iran war, which a month ago, Trump said that it will be over by now. But it seems like if anything, things have gotten worse. The Houthis entered the war and were launching missiles while threatening to block a second major shipping lane. Iran retaliated with drones and missiles at US bases across the region. Tehran's power got knocked out and Iran is already charging ships $2 billion per voyage through Hormuz and have drafted that into permanent law. To make matters worse, Trump is now tacoing so often that even his tacos are getting tacoed. For example, he promised to pause energy strikes for 10 days, only to attack Tehran's power grid anyway. He then mentioned about great talks with Tehran while sending tens of thousands of additional troops toward the region. Right after saying he has no plans to send troops to Iran, he also threatened Iran to reopen the straits or else, but then told his aides he's fine ending the war without it. At this point, I'm not even sure Trump knows what he wants. But as of yesterday, there are reports that Iran is now open to ending the war in exchange for security guarantees. And while the markets rallied 3% on the news, nothing is confirmed yet. So where could we go from here? Scenario 1. Everyone comes to an agreement. All sides agree to stop launching missiles at one another, and the world breathes a sigh of relief. But even in this scenario, oil prices are expected to stay high because Iran's and Qatar's gas facilities have been damaged, and repairs are estimated to take 3 to 5 years. So while the war has ended, the supply shock still remains. In this scenario, the S&P 500 could bounce back above 7,000 points. Scenario 2. Neither side backs down. While both sides want things to end, no one wants to be the one who backed down first. The war drags on. Iran continues to collect tolls on Hormuz traffic, except for Malaysia because they buddy-buddy. And they continue making meme videos to poke fun at one another. In this scenario, JP Morgan sees a near-term floor at around 6,000, with Goldman Sachs adding a further 5 to 7% downside if Hormuz stays closed through summer. And lastly, scenario 3. Things get worse. The US and its allies ramp up attacks on Iran, and in retaliation, Iran and the Houthis retaliate by attacking energy infrastructure, taking out refineries and even pipelines that the global oil market depends on. This would cause a supply shock on top of a supply shock, which would push oil prices even higher while triggering a steep recession. In this scenario, the S&P 500 could drop all the way to 5,350 points, which is another negative 18% from where we are now. Most analysts still see the stalemate as the most likely near-term outcome, but with ceasefire talks now on the table for the first time, that could change fast. Now, if you want to start investing, you need to keep your costs low. That's why I use Interactive Brokers. With Interactive Brokers, you are paying just 35 cents per trade on the US stock market. That's one of the lowest in the industry. They also give you access to Ireland domiciled ETFs, which can save you a chunk of dividend withholding taxes. And if you are not sure what to invest in, they also have a bunch of free company research tools built right into the platform, so you can do your homework before putting your hard-earned money in. Check out my link in the description to get started. Alright, now back to the video. So what does history actually says about markets during wars? Since World War II, there have been around 20 major conflicts. 3 months into the conflict, the S&P 500 gave a median return of just 0.7%, with the market being positive only 43% of the time. But 1 year later, the median return jumps to 9.7%, while being positive 73% of the time. The only exceptions were cases where the conflicts coincided with a separate macro crisis. For example, during the Russia-Ukraine war in 2022, the Fed was already hiking rates fast and furious. Then, when Russia was invading Georgia in 2008, the Great Financial Crisis happened. And during 9/11 in 2001, the dot-com bust was already underway. And then there's the Arab oil embargo in 1973, which a lot of people are comparing to today. Because at the time, the oil cartels cut off oil supplies for 5 months, triggering an oil shock that sent the S&P 500 to crash by 50%. However, what most people miss is that the embargo didn't cause the crash on its own, because it also happened at a time when the economy was already on fire. Starting in 1971, Nixon took the dollar off the gold standard and the dollar began weakening. The following year, wage and price controls were lifted, and that caused inflation to go up. By mid-19th century, producer prices were climbing at 10% a year, with the economy already stretched to its limits. Then, when the embargo finally hit, oil prices quadrupled in just 2 months, and when the Fed responded by cutting rates instead of raising them, the inflation spiraled out of control. So yes, there's currently an oil shock, and yes, valuations are elevated, and yes, tariffs are pushing prices up. But the conditions that made 19th century catastrophic just aren't there, which means a collapse is far less likely this time. So let's look at what the market itself is signaling right now. The S&P 500 has broken through its 200-day moving average, and that's a major bearish signal. The next key support is around 6,145, which was the level where the market peaked after you-know-who's Liberation Day last year. What's interesting is that if you zoom out to the monthly time frame, the 20-month moving average also sits at around the same level, which acts as an additional floor. For a bullish reversal, the S&P 500 would need to reclaim its 200-day moving average at around 6,700, which now sits above as resistance. But if 6,145 doesn't hold, the S&P 500 could continue falling towards 6,000, which is a major psychological level, and if even that breaks, the S&P 500 could drop another negative 20%, all the way to 5,130, where the 100-month moving average sits. Additionally, we are in year 2 of the presidential term, and typically, that's the worst year for the S&P 500, where it only gives an average return of just 4.6% versus the long-term average of 10%, while being positive only 52.6% of the time. The reason this happens is simple. Presidents tend to tackle the hard stuff early, such as foreign policy, wars, and structural reforms. Then, in the second half, when re-election starts to matter, they shift focus back to the economy. Data going back to 1931 shows exactly this pattern. The average midterm year peaks around April, before falling into negative territory through the summer. Then it bottoms out around October, and then rallies into year-end. One thing I find super interesting is that despite all the doom and gloom, several analysts are still optimistic about the market. For example, while JP Morgan has recently just cut their price target, it is still at 7,200 points. Goldman Sachs has also reaffirmed their 7,600 targets. Meanwhile, Tom Lee is even more bullish, where he gave a 7,700 year-end target. And his rationale is that the US is a net oil exporter, so elevated oil prices would actually benefit US earnings. And the most bullish call belongs to Oppenheimer, not the guy from the movie, but the investment bank, with a target of 8,100 points on the basis that AI and corporate earnings will keep pushing higher regardless of what's happening in the Straits of Hormuz. So is this actually a good time to buy? After all the drawdown, the S&P 500 change in price is now actually getting rather close to its change in forward 12-month earnings per share. What this means is that the market is now starting to match where earnings actually are, getting closer to the fair value. Additionally, the S&P 500 IT index now trades at only a 4% forward PE premium to the broader market, the lowest point since 2019, despite the fact that big tech continues to post double-digit earnings growth. Looking at individual stocks, some great businesses are also trading pretty close or even below their fair value. For example, for Microsoft, if I use a 17% future earnings growth rate, which is roughly in line with the historical averages, Growth Focus values it as slightly undervalued by about 8%. This is despite RCO growth remaining strong and none of Microsoft's actual businesses is being affected by the war. As for Alphabet, if I use an 18% earnings growth rate, which is slightly conservative relative to the historical averages of 22 to 25%, Alphabet would come out to be slightly overvalued by around 9%. But given that Google Cloud is growing at 30% a year, and search ad revenue has held up despite all the AI competition fears, even at a 9% premium, is probably not expensive for what you are getting. As for Meta, if I use a 16% earnings growth rate, which is well below their historical average, Meta actually comes out at fair value. Their ad revenue is holding up, their business is still fine, and they even finally shut down their VR world after spending $73 billion on it. And last but not least, Nvidia. Even if I were to use a conservative rate of just 22%, which is far below their historical averages, Nvidia still comes out at fair value. Their data center demand is unaffected by what's happening right now, and the hyperscalers are still ordering chips. So all these stocks are being priced as if the war has damaged them. The reality is that the fundamentals haven't declined yet. Now, I don't want to pretend I know where the market could go from here, but here's something worth understanding. The market doesn't price what's happening right now, but rather it prices what might happen in the future, which means that even when the headlines are peak fear, the market has often already moved past them. For example, March 2009, unemployment rates was still rising and banks were still falling. And just a month prior, Goldman Sachs was warning that the S&P 500 could fall by another 40% to 400 points. Despite all that, the S&P 500 bottomed at 666 points that same month. And what followed was the longest bull run in history. Likewise, in March 2020, the world had just gone into lockdown and the economy had ground to a halt. The S&P 500 dropped 34% in just 33 days before bottoming out in March 23rd, even before a vaccine existed. Then in October 2022, inflation was at a whopping 9.1%. The Fed was hiking faster than any time since the 1980s, and sentiment was at historic lows. And yet, the market still bottomed and was up more than 50% in the 18 months that followed. The pattern is the same every time. The market always turns even when things look like they could get worse. This is also why trying to time the market is so difficult. And as counterintuitive as it might seem, the best strategy during times like this isn't to wait for a bigger crash, but to invest consistently. That's why for myself, I'm just continuing to buy. Market up, I buy. Market down, I cry a bit, then I buy more. Anyway, that's all for this video. Like, share and subscribe as I'll be posting new videos every week.